The equity market rally continues. Live from New York City this morning. Good morning, good morning. Equity markets up 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, the labour market shows continued strength. The FDIC considers forcing big banks to pay up, and the Nasdaq entering a new bull market. We begin with the big issue. Don't call it a comeback.
What we've seen in the U.S. tech space.
Big cap tech has had quite a bid off the bond move.
It's really predicated upon the move in rates.
There's growth in the tech sector.
I'm a big fan of the information technology sector.
The best performance so far this year has not been in the cyclical sectors or the economically sensitive sectors. It's really been in the tech sector.
A little bit of an asset allocation grab as opposed to a fundamental basis behind the moves.
You're going to see people going back in there, as you've already seen.
It's probably too early to call this the 2020 playbook.
That's operating under the auspice of a Fed that's going to be cutting in the near term.
Markets and Fed are playing a game of chicken.
A lot of people thinking that we are going to have rate cuts.
We're not expecting any rate cuts for 2023.
It's premature to make that assumption.
Joining us now to discuss Mizuho's Dominic Konstam, Evan Brown of UBS. Evan, first to you. Are we going back to the 2020 playbook?
No, I don't think so. I mean, well, the Fed was easing then. Central banks were easing then. Now we're tightening, and we don't think that they're going to be easing, certainly not as aggressively as is being priced in. As we see from the data today, initial jobless claims still below 200K. Inflation is still an issue, both in the U.S. and Europe, and we're just not seeing so far much of a slowdown in growth that it would prompt the Fed to begin easing.
So, Evan, you think the degree of easing that's priced into this market right now is far too pessimistic?
Yeah, I mean, it's reasonable to have some amount of easing over the next couple of years, just given that at some point we're going to have a recession. But what we've seen through history is that in order to durably get inflation down when it's that high, you need to stay restrictive for a long time. And the Fed already has about a 0% growth expectation embedded in its forecast, which show rates staying on hold at 5% through the year. And we think the risks are that growth kind of muddles through and actually comes in better than what they're thinking. So not only does that say we're not necessarily cutting, but maybe they have to continue doing 25s before they're ready to really pause.
Dominic, is it safe to say that you're taking the other side of this?
Yeah, I'll take the other side of that, if that's okay. Yeah, absolutely.
Why is that?
I think the issue is basically the credit crunch that's around the corner. Credit conditions have been tightening globally anyway, both in the US and Europe, quite significantly. We know there's quite a decent lag between the tightening of credit standards and subsequent a slowdown in lending growth. Lending growth has been very, very strong. And what the banking crisis has done, even though it's the systemic aspect has been contained by the Fed and the other central banks, what it's done is it's brought forward that credit crunch. It's going to make credit standards even tighter and even sharper slowdown. So I think the slowdown is very much in place. We've gone from a soft landing opportunity, if you like, to what I would call a semi-hard landing, and I think it's inevitable that the central banks will have to fall into place and start cutting rates later this year.
Tom, this is really hard to measure, but how do you think about this? How do you equate what might happen with the senior loan officer opinion survey that comes out in the next couple of months with how many rate hikes the Fed should do, or rather how many they shouldn't do?
Well, I mean, what we do is we look at the growth sensitivity to various things, including financial conditions, the Fed funds rate, and also credit, basically, and credit loan growth, and reflecting that in the credit standards. And you can generate some pretty sort of interesting sensitivities, even if you think the level of the funds rate was appropriate before the latest sort of banking issues. I would argue that the credit tightening that's now basically being implied over the next few months is worth at least 100 basis points, if not 150 basis points in Fed funds, just to sort of, break even, so to speak. So to the extent that we were anyway in the camp that we thought the Fed had raised rates sufficiently far in terms of slowing growth, you could argue they could easily need to sort of scurry back to a sort of, 3 handle on the funds rates, before too long.
Evan, to be blunt, why do you think Dominic's wrong?
Well, I mean, the slowdown that we're going to get from a tightening in credit conditions is the reason why the Fed didn't go 50 basis points, is the reason why, market pricing getting up to 6% has been removed and from market pricing. So, we can't forget, the starting point, right? Nominal growth, 6-8%, nominal incomes growing really fast. We also can't forget that there's been some easing of financial conditions as well, with rates coming down, with oil coming down, and that's going to support real disposable incomes even further. So, it's hard to calibrate exactly what this credit tightening is going to do. That's why the Fed is not doing 50s. But in the meantime, we're not seeing a pullback in mortgage applications. We're not seeing an acceleration in deposit flight. We're not seeing a corporates coming in and saying that they're observing a big slowdown in consumer spending. So we need to start seeing at least some of that in the data before we get, really bearish on the economy and think the Fed's going to be cutting rates imminently.
Dominic, you touched on this. How long does that typically take? And will the Fed have information in hand when they make a decision on May 3rd?
Well, the lags that we find are, between sort of 6 months and 12 months in terms of the actual hard economic data. So you're not going to see it kind of right now, although, as I said earlier, that, we have seen some tightening in credit conditions anyway, from late last year. So I would expect you'll start to see it during the second quarter, back end of that. And it's possible it will become clearer for the Fed come the June meeting. But basically, by the second half, I think it's going to be fairly clear what's going on. And I think, I think we need to make a distinction in terms of, parts of the economy that are prone to slow more than other parts. And obviously, commercial real estate is kind of, on the radar screen of most people. It is showing definitely some signs of stress. The smaller banks are very important in commercial real estate lending. And so they're the ones, if you like, are going to be at the forefront of some of this tightening of credit conditions. That doesn't necessarily mean, widespread job losses and a sort of a classic sort of housing-led consumer type recession. It still means, though, a significant slowdown, and one that the Fed needs to respond to sort of contain, what would otherwise be, other damage to the economy. So that's a kind of slowdown. And at the end of the day, I would say that, this is a semi-hard landing. We're not going to go into a deep recession. We're basically having a decent slowdown. Inflation will follow its course on the back of that. Remember, inflation isn't necessarily being driven, by consumer demand being rampant. It's sort of other factors are involved in that. And so I think it will just sort of lay the case for the Fed being able to unwind some of these rate hikes, basically.
Let's talk about the data. 198,000 jobless claims, still sub 200K, just ticking just a little bit higher. Mike McKee on top of this. Morning, Mike.
Good morning, John. And you mentioned the jobless claims numbers. They certainly don't indicate there's a problem, but it's sort of like those movies where it's a beautiful day and what the characters can't see is the big storm over the horizon. That may be where we are. You talked to Steve Pagliuca from Bain Capital this morning. He said the planes are full, the restaurants are full, people are out there spending. But that's not what some of the private data collectors are finding. And there may be a sort of a dichotomy between what the Fed's seeing in the government numbers and what the private industry is producing. Visa is here. They did a demonstration yesterday of their card spending index, and momentum has definitely slowed, they say, and not just momentum in general, but momentum at the lower end of the spending and income categories. Spending, to the extent that it's holding up, they said, is from the wealthier people who are buying more stuff while everyone else is buying less. They put the chance of a recession at about 60%. We will get some of that government data tomorrow. We get the income and spending numbers, and they're supposed to decline, both incomes and spending. Of course, January you get a big pop in incomes with Social Security COLAs, et cetera. But it's the spending that people are going to be watching, and of course the inflation numbers were expected to show a drop going through the month of February. But does that mean that we are almost out of the woods with inflation, or the Fed still has to go more? Data just aren't clear enough. We can't see over that horizon yet.
Mike McKee, thank you, sir. Down at a conference in D.C. and looking forward to your coverage for the next couple of days. Don't miss this. Tomorrow, 8:45 a.m. Eastern Time, Susan Collins of the Boston Fed. The Boston Fed president catching up with Mike McKee tomorrow morning. We'll take that in full, of course, on Bloomberg TV and on Bloomberg Radio. Dominic Constant, Evan Brown, still with us. Evan, I want to come to you. You've got a different view than Dominic on the bond market, on yields, on rates, on the Fed. Got it. Do you have a different view then on where you think the leadership should be in the equity market based on what we have seen develop in the year so far?
So what we have seen develop is over the last month, the NASDAQ has outperformed regional banks by 32%. And that just seems very, very extreme to us. And we think will be unwound as people recognize that the economy is not falling off a cliff, that we are muddling through. Certainly banks will have their challenges, but that looks way more than priced in to us. So we're looking for a tilt back into value from growth from here as rates reprice higher.
So higher yields. Dominic Constant, I've got a note from you that has yields dropping below 3% in the coming months. Now, Dom, is that right across the curve, 2s out to 30s?
Well, I think it'd be, it's going to be led, it will be led probably by the 5-year, but the front end essentially bringing it down. I mean, obviously the timing for the first Fed cuts would determine how well 2s do and all of that. But yeah, I mean, that's the general idea. If the Fed is going to be in easing mode in the second half of the year, it's going to be sort of front end led basically, and the curve re-steepening essentially.
Essentially making a market between Mizuho and UBS right now on this program. Two completely opposing views right now. You guys are going to be sticking with us, I'm pleased to say. In the equity market, we're positive about 0.6% on the S&P 500. With some movers going into the open, here's Katie.
Let's start with Alibaba, because, of course, the news this week was that the empire is going to split into 6. And now, according to people familiar with the matter, Alibaba's $20 billion logistics arm is said to be preparing for its Hong Kong IPO. That could come as soon as this year. The stock is up slightly. Also up this morning is Roku, following news that it's going to cut about 200 employees. That comes out to about 6% of its workforce. Cost cutting obviously in vogue across industries right now, and you can see shareholders rewarding that move. Moving on, we have Charles Schwab. It was hit with a downgrade at Morgan Stanley, and this is interesting, John. It says that clients are moving money from Schwab at twice the pace that analysts had expected and putting that cash into money market funds. That's a problem for the banks, and it's a problem for Charles Schwab, as you can see. And finally, RH. It's dropping pre-market after delivering weaker than expected full-year guidance, and you can see that disappointment in the shares.
Katie, thanks for that. I'll pick up on that Schwab call around the opening bow. Looking forward to doing that with Katie a little bit later this morning. Equities right now up 0.6%. Coming up, bank hearings wrapping up on Capitol Hill.
Anytime you have a bank failure like this, bank management clearly failed, supervisors failed, and our regulatory system failed.
That conversation up next.
We need competent financial supervisors, but Congress can't legislate competence.
The examiners and your supervisors were asleep at the wheel.
I mean, it didn't seem like there was any enforcement.
Signs that Silicon Valley Bank was heading towards a collapse were staring them right in the face for many, many months.
It seems like they blew you guys off and you didn't do anything.
Anytime you have a bank failure like this, bank management clearly failed, supervisors failed, and our regulatory system failed. So we're looking at all of that.
House lawmakers ripping into financial regulators and closing out another week of congressional hearings, now grappling with the aftermath of these bank failures and a $23 billion tab. Bloomberg reporting the FDIC is looking for the big banks to help foot the bill. This coming as Secretary Yellen highlights the potential cracks in regulation, warning in prepared remarks that efforts to roll back some post-2008 reforms may have gone too far? Your team coverage begins right now with Bloomberg's Anne-Marie here in New York, alongside Katanga Johnson down in D.C. Katanga, first to you, just on the FDIC and how they're going to raise that money. What's the approach going to be?
So the FDIC is really considering tapping the largest banks on Wall Street to contribute a special assessment or a larger portion toward the Deposit Insurance Fund. Big banks already pay a larger amount because of the number of deposits or market share they have, as well as just a higher rate that they're required to contribute. However, the FDIC really wants to stave off having smaller banks, community banks, between that 100 billion to 250 billion paying more toward this. And that's causing a lot of consternation on Capitol Hill. There's also a big lobbying effort by the small banks to make sure that they don't all be looked at with tougher regulation just because a few small banks failed.
MH, that's the raising effort, the money raising effort. Let's talk about the regulatory effort. Secretary Yellen says it's incomplete. We need to do more. What does she mean by that?
Well, she's obviously talking about the rollback of some of these Dodd-Frank regulatory congressional rules in 2018 under the Trump administration. So she says these events remind us of the urgent need to complete, Jonathan, she calls it unfinished business. What she wants to do is look at some of the loosening of those financial requirements that happened in 2018 and see if any of that added to this risk that we saw with the collapse of these three big banks. Remember, Jonathan, and you talk about this a lot, this was done in a bipartisan fashion. 17 Democratic senators and 33 congressmen and women signed up and voted for this. And if you're looking at a divided Congress right now, they are not going to be able to have more regulatory approval.
So, Katanga, what you've also heard as well, sir, over the last couple of weeks, the last couple of days specifically, it's not just about regulation, it's about enforcement. Now, you heard from Michael Barr, the Vice Chair of Supervision at the Federal Reserve, that bank leadership had failed. Well, they lost their job. Regulatory issues have failed. Well, what happens to the regulators? What happens to them?
Well, Barr made clear that in the first instance, he takes responsibility into the ways in which maybe the agency was, as we heard from one of the representatives, asleep at the wheel. And there's a review of how exactly the agency may have fallen short in its supervision. That report, based on its findings, will come out on May 1st. Barr also says he's open to an independent investigation whether Congress or the Government Accountability Office wants to look into what went wrong here. Essentially, reviewing what went wrong, potentially proposing new rules is within the remit of the agency, even without any congressional nod to new legislation. And Barr really wants to show that he is focused on both of those things.
Katanga, thanks for that. Alongside Anne-Marie, good to have AMH here in New York City with us. She's going to stick around through the weekend. Dominic Constant, Evan Brown, back with us. Evan, a week ago, I think you would struggle to find people that think we could address this crisis without some kind of legislative action. Do you think we can avoid that now?
I think we can. I think we've seen enough from the Fed and the FDIC to at least stop the bleeding, right? There's certainly going to be an increase in regulation that weighs on earnings of these regional banks. There's certainly net interest margin pressures, but in terms of the liquidity crisis, that's been addressed. And credit to the policymakers for acting fast on that front.
Dominic, do you think it's been addressed?
Yeah, I mean the ring fencing of deposits is obviously extremely important. I don't think the real cause of the cause of this is kind of well known. It's sort of the weakest link in the system is going to be exposed when you have a lot of unrealized losses in security portfolios and a dependence on relatively few very large depositors, and that triggers it. So the Fed has been able to contain it. It's not clear that you need a whole new round of regulation. I don't think the unraveling of some of the Dodd-Frank stuff for the smaller banks was really the issue either. So this seems to be a bit unnecessary, but it is a sort of consequence, if you like, of ramping rates up a lot, generating these sort of would-be losses, and you expose the weakest banks. You're always going to do that, but the Fed, is basically on top of it now, I think. Doesn't mean we're not going to have a credit crunch, but they are on top of the banking issues for sure.
Dominic, what is it about this that you think is inevitable now, after just 2-3 weeks? Why are you so sure this leads to some form of credit crunch?
Well, I mean, you just look at the survey data on lending standards and make the linkages to loan growth and run that through sort of basic models for growth. It's to me it's pretty obvious. We're going to see a very decent slowdown from strong levels. I mean, it's not a bad thing necessarily that some of this happens if you want to bring inflation down. The question is just the degree of it. I mean, it could be just a little bit egregious, and that's why I think the Fed rightly is going to respond to this and is prepared to respond to it. That's basically the message from Powell. I mean, there's nothing. This isn't rocket science. I mean, if you're going to get a big slowdown in lending, you're going to see a big slowdown in nominal growth, and that will show up in inflation. So it's getting some of their job done. So I think it's just a question of degree, and if they delay too long, then the negative sort of knock-on effects will be unnecessary. And we've always been in the camp of a soft landing, and there are good reasons why you could have a soft landing. This obviously makes it a lot less soft. But it still doesn't mean you're going to have a terribly hard landing. It's just that the Fed has to be very sensitive to what's around the corner, basically. And I'm sure they will be. And that's really the main message.
Evan, you draw a pretty clear distinction, though, between what is a catalyst for slower growth and what is a catalyst for something worse. What's the biggest difference?
Well, look, yeah, we see the starting points, the household balance sheets, as in the labor market tightness, where we just don't see much evidence at all that there's even any weakness. So as long as that's the case, it's hard to predict that everything is going to crash on the economy. And it just looks a lot more like a muddle through. And that's not going to bring inflation down as quickly as the Fed wants to see it.
So it's March 30th. Let's do this. Let's reconvene at the end of April in about a month, and we'll do this panel again. Dominic Constant, Evan Brandt, to the two of you. Thank you. Your equity market up by 0.7%. Coming up in the morning calls and later, mixed signals, the search for opportunity, detailed by sector contradictions. That's the view from JP Morgan's Jack Caffrey. Stocks up, Nasdaq in a bull market, everything's fine. The equity market up 0.7%. Let's get you some morning calls. First up, Evercore upgrading Walmart to outperform, expecting the retailer to benefit from the challenging macro environment. That stock up by 1.3%. JP Morgan upgrading Philip Morris to overweight, naming it their top pick in tobacco due to its compelling valuation and increasing growth potential. And finally, Katie mentioned this one, Morgan Stanley downgrading Charles Schwab to equal weight, saying clients are moving their cash at a much faster pace than anticipated. That stock negative by a little more than 1%. Coming up, bank stocks and the home builders telling two very different stories. That conversation up next with Jack Caffrey of JP Morgan. 23 seconds away from the opening bow this morning. Good morning to you. Equities higher by 0.7% on the S&P. On the Nasdaq 100, back in a bull market, 20% plus higher than the December lows at the close yesterday. Nasdaq futures up 0.75%. Let's the opening bow, switch at the board and get to the bond market. Yields look like this on a 10-year, higher by a single basis point. Up by a basis point to 357.72 on a 10-year. In the FX market, reclaiming 109 on the euro against the dollar. Euro dollar 109.19, positive 0.7% more broadly through G10. A much weaker dollar story. Outside of that, crude just short of 74, 73.70, up a little more than 1%. About 20 seconds into the session, your equity market looks like this on the S&P, up 0.6%. On the Nasdaq, we had some more weight to that rally, up 0.7%. The one big sector to watch at the open is big tech. The Nasdaq 100 entering a fresh bull market, climbing more than 20% from its low back in December. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. The mega cap story has been a March story as well. You look at the performance of the top technology names, and it's really the easing that's driven this in the last 30 days or so. Interesting look at Alphabet, by the way, 1.4% lower in the market. The reason that I flagged that is that March has been very good for the Google parent, but it's the only mega cap that currently trades at a discount to the NASDAQ 100. It's trading at something like 24 or 17 times, forward earnings compared with the 24 times forward 12-month earnings that the NASDAQ 100's on. In a bull market, as you say, up 21% since that December low. If you look at this kind of more holistically as a quarter, the NASDAQ 100 heading for its second best quarter in the last decade. The story here, Jonathan, is the Fed, but not necessarily just about rates and where our head is at in the outlook or trajectory for rates. I think we've got a fantastic terminal chart that tells the story in a second, but the idea is that the NASDAQ 100's kind of biggest move in recent weeks, a 10% leg higher over the back half of March, has coincided with the Fed's balance sheet expansion, right? And that has seemed to be one of the drivers that have been really pushing. That Nvidia performance on a year-to-date basis is pretty extraordinary. That is a stock that trades more than 50 times forward earnings, but it's caught up in the euphoria around artificial intelligence, which on the Bloomberg Technology Show, artificial intelligence is the most said phrase that I use on a daily basis, John.
Well, I'm looking forward to the coverage a little bit later with Caroline Hyde and Ed coming up at around midday New York time. Can we get that board back up? And Ed, thank you for that, mate, as always. Look at Meta year to date, the year of efficiency. Meta absolutely flying this year. Year to date up something like 70%. And think about where these gains have come from and what's happened in between. We've not even wrapped up the month of March, or the first quarter for that matter. We've seen a high of a 2-year north of 5%, a low south of 4%, somewhere in between right now. Meta, the year of efficiency, the year of more than that, up by 70% year to date. Unreal moves on some of these names. Let's get you to some breaking news that came out about 5 minutes ago. Katie, it came from Bed Bath & Beyond.
And we know this retailer has been struggling. Interesting insight right now. Bed Bath & Beyond is filing to sell up to $300 million worth of stock. It's going to do that through B. Riley Securities. We got some numbers as well, reporting that prelim fourth quarter comp sales are going to be down 40 to 50%. John, the estimate had been for a drop of about 25.9%. We also got fourth quarter net sales seen at about $1.2 billion. The estimate had been for $1.3 billion. So some disappointing numbers to go with that share sale. And you can see shares absolutely tanking right now, down 6%. Fair to call this a penny stock. It's at an all-time low of about 75 cents.
And 6% maybe is like unchanged for that particular penny stock. Katie, you mentioned this call earlier. I wanted to share more of it, Katie, from Charles Schwab, or rather on Charles Schwab from Morgan Stanley. They've removed the name from its buy rating for the first time since starting coverage 7 years ago. This is what the analyst had to say. With limited visibility on multiple variables, we're moving to the sidelines while clients aren't leaving and Schwab has other sources of liquidity. Earnings face more pressure than we had expected. Now, Katie, that's one part of the financial sector. How's the broader issues going?
Well, if we look at some of the regional banks that have been under a lot of pressure, the likes of First Republic, PacWest, and Western Alliance, they're seeing a little bit of a relief rally today, or at least some relief overall. You can see all of those names up about 2% or so. And then you get to Charles Schwab, and you see that pressure once again down 2.6%. And even though those names I mentioned, they're seeing a little bit of a rally today, if you look overall, we know that regional banks have been under a lot of pressure. You can see that if you look at them compared to the broader financial sector. Of course, both of those ETFs that we're looking at are down mightily, but the regional banks have really felt the brunt of this sell-off. And this is an ongoing problem, really, this shift of deposits that's really hitting Charles Schwab today. Even though it seems like the worst-case scenarios are starting to get priced out, the fact that you have people aware that they can get higher yields outside of their banks is going to continue to put pressure on this story, and we'll get another look at that deposit data tomorrow.
Katie, thanks for that. We're about 5 minutes into the session. Your equity market is up by 6%, or rather 0.6% on the S&P. Before you get too excited, on the Nasdaq, we're up by about 0.7%. Jack Caffrey of JP Morgan sees conflicting narratives within the equity market. He says bank stocks have suggested a massive credit problem is coming, while home builders rallied early in March and have held up surprisingly well, despite what they sell needing credit to work. Those two sectors going in different directions so far this year in a major way. Jack Caffrey joins us right now. Unreal to see that, Jack, to see the banks down 17% and the home builders up 17%. What explains that gap, that divide?
Well, I think investors on one hand were trying to almost anticipate a recession before we even went into the recession. And that had us looking at what are the traditional early cycle movers. And home builders typically being that. Parts of retail also early cycle movers. But also the banks are supposed to be the early cycle movers. And they typically would respond nicely to some flattening of the yield curve. The challenge, I think, though, is we have these issues with respect to bank funding, bank costs. And increasingly, when you think about a senior loan officer survey pointing to tightening credit conditions, you can understand where the banks and bank investors have so much on their minds and why they've been so negative. The fact that investors still keep coming back to the home builders, though, I think is a tricky one, and I think indicates that equity investors really want to play for a rally, for a recovery, and feel almost the sense that they can't afford to miss it and miss the turn. With the decline in the 10-year, I understand why they're going there. I just think they're probably a little bit too early in trying to embrace that all clear in the market.
So, Jack, just to be clear, you think that spread does need to be reconciled, and it's reconciled by the home builders coming down towards the banks?
I think more likely it's the home builders come back to the banks, but from a portfolio perspective, I'd rather the banks begin working, to be completely candid.
I hear you. Are there reasons to believe the banks will start to work sometime soon?
I think that ultimately we're working through the worst of sort of the news, the concerns. We've worked back through the idea that, you know, the Federal Reserve has been willing to backstop banks in terms of making lending facilities available to address their liquidity needs. I think that takes some of the fear off. There remains the uncertainty on which way regulation goes in terms of how they refund the gap that will appear in the FDIC's reimbursement accounts. And ultimately, though, I do think the big banks wind up being, you know, effectively the fortress and the citadels that wind up actually continuing to attract deposits, can service their clients, can offer not just a reliance on net interest margins, but generally have businesses built around fees and I think it's that fees and business that becomes much more interesting until we get a true all clear and experience the recession that we keep talking about, but which at the same time seems to be being pushed a little bit further and further out, whether you look at the GDP numbers we got this morning, or when we started talking about housing and home builders, existing home sales yesterday being much stronger than expected, and for the third month in a row.
Jack, it feels like we've been in Q1 for a lifetime, a decade, maybe even longer. Now, Jack, we haven't been. It's been 3 months. It just hasn't felt that way. Jack, when it wraps up, we'll start looking ahead to earnings. I think we can do that right now. Bank earnings on the 13th, 14th, First Republic and JP Morgan, which, of course, you can't talk about directly. But for the broader universe, Jack, what would you expect from bank earnings for this quarter?
You know, I realistically think the issue that's going to come out of bank earnings is going to be, A, guidance on net interest margins, and what's clearly become foremost on investors' minds is going to be sensitivity to deposit rates. To what extent we can get some clarity in terms of how much banks might have to begin paying up for their deposits, watching these outflows occurring to money market funds. Secondly, and I think this has become the trickier one, is what do credit losses look like? We've spent so much time thinking about the pressure on a mark-to-market basis on those financial institutions that have had securities-heavy portfolios. Two things to keep in mind. Interest rates are lower now than they were at December 31st. So to some extent, those security-heavy portfolios, excuse me, probably have lower losses than you were thinking they had 3 months ago that people have been talking about in terms of being a pressure point. But secondly, you know, if you say a bond is worth 90 cents on the dollar, and that bond is effectively issued by the U.S. government, shouldn't have credit risk, and you have a portfolio that does have some credit risk, why are we thinking those loans are worth necessarily par still? And so I do think that there should be some pushback in terms of how can you tell me we don't have some incipient credit risks being identified and working their way into the balance sheets and through the income statements as well. So I think that's where investor attention focuses on. Cost pressures from interest, credit possibilities becoming something that we have to start talking a little bit more about. And then some fee income questions. Can we actually see some uptick from all the volatility you've experienced? Can those security-centered banks actually make a little bit more money on their trading desks?
Jack, it's funny, when I ask people for their Fed call for May 3rd, I ask them if they're going to have sufficient information by then to actually make a call. But for the banks, that's only a couple of weeks away, Jack. How much information can they actually give us about what's developed over the last couple of weeks?
Well, I think it's probably going to be much more qualitative in terms of how they describe their operations, what they're paying attention to, rather than actually giving you specific point estimates or specific point adjustments. Basically, banking is a business wrapped around an assumption, around the model, around the hypothesis, and with a guess. And so that there's a great deal of focus and estimate and guesswork and accrual at the expense of necessarily the idea of hard cash.
Hey, Jack, wonderful work as always, and great to get your perspective. Jack Caffrey there of JP Morgan. The KBW Bank Index, 5 days of gains. Longest daily winning streak of the year so far. And if it sticks, that's a gain over the last 5 days of about 6.5% on the KBW Bank Index. Now, yes, hammered month to date, year to date, I know that, but a bit of a bounce over the last 5 sessions. Coming up on this programme, tumbling energy prices taking a bite out of German inflation.
Energy prices affect the entire economy. This is actually one of the factors that explains why core inflation is more persistent.
Plus, Amanda Lynham of BlackRock joining us on the credit market. That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Ali Dabaj, Janus Henderson CEO. That conversation at 3:30 p.m. Eastern, 8:30 p.m. in London. This is Bloomberg.
The energy prices affect the entire economy. It really moved very quickly into core inflation. And now the interesting question is it going to drop out at the same speed? My suspicion is that is not the case. This is actually one of the factors that explains why core inflation is more persistent.
Inflation across the Eurozone starting to ease. German CPI falling sharply with numbers in Spain plunging down to a 3 handle. The ECB now grappling with its next steps amid ongoing banking concerns. The chief economist, Philip Lane, saying the central bank will need to keep hiking if financial tensions settle. Guy Johnson joined us out of London now. Guy, just explain how different the situation is in Europe compared to what's happening here in the United States.
OK, let's start with the inflation side and let's start talking about what's happening with core. So Schnabel's talking about it there, Isabel Schnabel at the NABE conference. What we've seen today, Spanish inflation coming down 6 to 3.1, but the core number sticky at 7.5. Germany doesn't break it down, John. The headline number in Germany comes down quite sharply from 9.3 to 7.8. The expectation tomorrow, when we get the full Eurozone number, is that the headline number is going to come down, but core could tick higher from 5.4 to 5.5. And this is the ECB's problem. This is where it really has an issue that it has to deal with. And this is why there is still an expectation that the central bank is going to continue to hike and maybe hike on a different kind of trajectory and with a different magnitude that we're going to potentially see from the Fed, John. The other thing as well that I thought Schnabel said was interesting today is that we're not seeing the deposit outflows out of European banks. So park Credit Suisse, maybe Europe doesn't have the same banking crisis as we're seeing developing in the United States. Europe maybe has a lower deposit beta, and that's going to allow the ECB maybe to go harder at the underlying inflation that it now faces.
There just seems to be the financial shock. There seems to be this view the financial shock here, Guy, has some kind of disinflationary forces that don't exist in Europe. Guy, I know you're going to pick up on this story with Alex Steele at the top of the hour, so looking forward to your coverage in about 10 minutes' time. What does this mean for the credit market? This is Amanda Lynham of BlackRock. The expected contraction in credit availability that is likely to follow the recent disruption in the banking sector warrants a rebuild of risk premia above and beyond the spread widening that has already occurred over the past few weeks in both the US and European credit markets. Amanda, I'm pleased to say, joins us now. Amanda, great to catch up with you as always and good to see you. We've had some spread widening. We know that. You say it's not wide enough. What is wide enough?
Thanks, John, for having me. It's great to be with you. I think, look, when we're looking around the credit markets, both in the U.S. and Europe, as you alluded to, we've seen some widening at the index level, but realistically, we're not that far from the median over the past 2 decades. And we think that with the downside risks to growth, with the contraction in bank lending that we expect, we do think that an additional rebuild of risk premia is warranted. Now, this will largely depend on how severe of a contraction in bank lending that we see. We're already seeing some some signs under the surface of levels of distress picking up in the credit market. So if you leave the default rate aside, which is fairly backward looking, but instead look at real-time valuations, what we're seeing is that the share of bonds in both the US and European high yield fixed income markets trading at distressed levels or above 1,000 basis points has picked up to levels that we haven't seen in the US since the summer of 2020. So the market is signaling that there is some concern. Now, that's largely concentrated at the low quality end of the spectrum. And as you know, we define quality differently than ratings, but we see scope for that trend to continue. And so we're definitely focused on capturing opportunities around alpha, and that's what we're recommending to our clients. But at the same time, we want to stay somewhat defensive and really wait for that rebuild of risk premia to kick in. And if it's not the downside risks to growth from a contraction in bank lending, then it's likely to be ongoing inflationary pressures. And as you know, we don't expect a rate cut this year. And so there's really kind of two risks that we're monitoring very closely.
So Amanda, let's pick up on the rate piece, and I want to come back to sectors in just a moment. You don't expect rate cuts this year. This market is pricing in monster moves this year. How do we resolve that gap?
I mean, I don't know that we're going to resolve it in the near term. I think what we're watching very closely is the magnitude of the contraction in bank lending that we expect. So we've all seen that the various surveys that you've been referencing all morning have been tightening over the past few quarters. But if you dig under the surface, most of those survey respondents have been tightening moderately as opposed to tightening significantly. And so I think that will really develop over the next few quarters how much of a contraction that we get. And that may reprice the market's expectations in terms of are rate cuts warranted or not. I think, frankly, where we stand is that the bar for a rate cut is very high, given the elevated services inflation that's in the market right now. And I think in order to see a rate cut, we would need to see severe contraction in growth, coupled with clear and compelling evidence, as Chair Powell's referenced, on inflation coming back down to target. It doesn't mean that it needs to reach the target. Obviously, we won't be there this year, but it needs to be clearly moving in that right direction. And I think that inflation piece is a key ingredient to the potential for a rate cut. And so that's really what we're watching. In addition to that, we're also watching trends, for example, in the primary corporate credit market. So we've known that high yield supply over the past 3 weeks has been very, very light. We broke the drought of 3.5 weeks earlier this week. I think as it stands right now, we're viewing that light supply in the high yield market as a sign of issuers' unwillingness to tap the market at these levels, as opposed to an inability to do so. But as we know from the March 2020 experience, the Fed watches those markets very closely. And I think if we were to see a dysfunction in the primary credit markets such that borrowers could not tap that at any price, that would be really concerning. So basically, Amanda, either the Fed's going to get the job done or the market's going to do the job for them. Either way, it's not good for credit. So when you think about sectors, Amanda, which sectors do you think are most exposed to a tightening up in credit standards going forward from here? Right, exactly. So we're really cautious on sectors that kind of have this combination of a large degree of variable costs in their debt funding structure, limited pricing power, economic sensitivity, and a high degree of costs as it relates to labor and wage pressures. So sectors in that bucket would include retail, restaurants, and healthcare. But I would stress, under the surface, there's been a lot of dispersion even within sectors. So there are areas like food and beverage and retail, for example, where there's different levels of sensitivity across the different subcategories. And so it really does take a careful eye to kind of parse through these groups. The other, I think, really interesting takeaway for credit investors outside of the sector discussion is the asset allocation discussion. And really one of the main takeaways that we've seen from the past 3 weeks is that we see some structural tailwinds for the private credit market as it relates to the expected contraction in bank lending that we expect, namely for the private credit market to expand its addressable market and maybe reach a wider pool of potential borrowers. And then also the opportunity for it to enhance its pricing power relative to what we've seen previously because of the certainty of execution that it provides. Interesting. Amanda, can I just say, great to see you in a new seat. BlackRock are very lucky to have you. We'll talk again soon. Thank you for being with us. Amanda Lynham there of BlackRock.
In the equity market, about 23 minutes into this session, we look like this on the S&P, up 0.6%. On the Nasdaq, a similar move. We add more weight to that rally. Coming up, your trading diary.